Yeah, so very, very interesting transaction here. A&W Revenue Royalties Income Fund. So this is a company that we had coverage on in our income research a while back. We've updated it, since then. I believe I had it as a year stock our take a couple of months ago, and we've always thought that it was an interesting business. We've liked the business as a yield play. One of the things that I did mention on the year stock our take is that the growth had slowed quite significantly recently, and we weren't expecting them to achieve some of those double digit growth rates that they were able to achieve in the past. But essentially, what they are is they were established to invest in the trademark of the A&W brand and the restaurants across Canada. So they essentially they're royalty income funds. So they receive a 3% royalty on the gross sales of A&W restaurants in the royalty pool, which as of the end of Q1 of this year was 1,047 restaurants. And I think that they've added a couple few since then. But we'll look at the company here. So symbol AW.UN, it's trading right now at $35. It's about a $512 million market cap company. And today it is yielding 5.5% income yield. Now, big news for the shareholders of the company uh, just recently issued today, and that is the proposed combination of A&W Food Services with A&W Revenue Royalties Income Fund. So, just to kind of explain how this works, A&W Food Services, this is the corporation that owns A&W, owns the brands, owns the restaurants across the country. A&W, they're not a publicly traded company, so the public cannot invest in A&W Food Services. The publicly traded company is A&W Revenue Royalties Income Fund, which is AW.UN. So this is the stock that invests in the trademark of A&W restaurants and gets that 3% gross royalty. So a proposed combination of these two entities. Let's look at some of the details of this proposed transaction. So they're looking at essentially combining the two entities into a simplified traditional corporate structure. So there will be no AW.UN post transaction. It would just be one company. The name of the new company would be A&W Food Service New Co. New Co would expect to pay an initial quarterly dividend at the same rate as AW.UN. So that's currently equivalent to $1.92 annualized per share. The transaction is expected to close in October. It's still subject to customary closing conditions like regulatory court approval and then also shareholder approval. I'm not seeing any issues with this. I'm sure they're going to get the shareholder approval, and I wouldn't see any reasons why they wouldn't receive regulatory approval as well. So A&W unit holders right now can either receive $37 per unit in cash, or upon closing of this transaction, they would receive one common share in the new co company. And this cash offer represents a 30% premium to AW.UN unit holders based on the price right before the transaction was announced. So when we look at a 3-month stock chart, we can see here 23% jump in the share price in a day based on this transaction. So that's a pretty nice 1-day gain for any of the AW.UN unit holders. However, when we look at a longer term stock price, let's look at the 3-year stock chart here. We can see that this really just brings shareholders back to where the unit price was about a year ago, and still well down from the highs that AW.UN achieved in 2022. Now, the company has released some projections in terms of what the combined entity would look like. So they're looking at same store sales over 3 years at about 3 to 5% per year. Some growth, about 2% to 3% growth in the number of restaurants in the network. So overall, they're looking at annualized sales growth in the range of 5 to 7% per year. So that's not bad. Moderate growth. We wouldn't necessarily expect this to be a major growth company here. And then as well, some growth in adjusted EBITDA, roughly in line with the revenue growth. So the combined entity based on 2023 numbers would have adjusted EBITDA of about 91 million. They're targeting net leverage, so net debt to EBITDA leverage of 3 times, which is a reasonable ratio, certainly for a restaurant business. There'd be about 24 million shares outstanding at the end. So the current unit holders of AW.UN would own 41% of the business. Important to understand here is that A&W Food Services also owned a significant stake in AW.UN, so that 41% is excluding A&W Food Services. And the current shareholders of A&W Food Services, again, this is not a public company, but it still has shareholders. They would own 59% of the new entity. So what I wanted to do here is just do a little valuation analysis on the new company here. We're looking at an expected dividend of $1.92, expected shares outstanding of 24 million shares. So when it actually starts trading on the market, well, we don't know what the share price is going to be. We do know what the dividend is expected to be. So if we're going to run a couple of scenarios here, I would say that reasonably speaking, we would look at the market dividend yield once it starts trading to be anywhere from 4 to 6%. Four on the low end. I'm not sure if it's going to quite get there. Probably six would be close to the high end. So based on the expected dividend and what we would expect to be the dividend yield range, if it is trading at a 4% yield, then you'd be looking at a $48 unit price or share price post transaction. Now, based on the growth rate and where other dividend stocks are trading right now, I don't think the yield is going to be that's a little low, 4%. Likely it's closer to the 5% range, which would put the share price at about 38.40, just slightly above the $37 that AW.UN unit holders are being offered here. It could trade at a higher yield if investors see a higher level of risk, or they're unenthused by the growth projections, or perhaps if the company makes a couple of missteps early. So it could trade at a higher yield. And if it's at 6%, you'd be looking at a share price of $32. Now, in terms of valuation on an EV to EBITDA basis, so I'm going off of the midpoint of 2025 expected combined EBITDA, and I'm also assuming a leverage ratio of 3 times. You would be looking at a share price of $48. You'd be looking at EV to EBITDA of 14.5 times. At the 38.40 share price, 12.2 times, and at the $32 share price, about 10.7 times. Now, the only really close comparable in Canada would be Restaurant Brands, which trades under the symbol QSR, both in Canada and the US. So Restaurant Brands right now is trading at an EV to EBITDA multiple trailing of about 14 times. Now, this isn't a perfect comparison. So Restaurant Brands owns Tim Hortons, they own Popeye's Chicken, they own Burger King as well. Far larger company, globally diversified. It's had a better growth track record. On the other side, it does have a much more leverage on the balance sheet. Think about 6 to 7 times net debt to EBITDA. So there's some gives and takes there, but generally speaking, I would not expect, given the projected growth, uh, the new A&W to have a higher valuation than Restaurant Brands. More than likely it's around that 14 times EV to EBITDA or lower. So I'm really saying I'm really thinking that probably a 5% yield, 12% EV to EBITDA is probably what we'd be expecting here, which would put the share price roughly around where the takeout offer is at $37. So our take on this transaction in Newco, I mean, the advantages are there is potential for a moderately higher growth rate. Another thing is that the standard corporate structure may make Newco more accessible to investors. There are some institutional investors that can't invest in income funds. There are some non-institutional investors that just don't understand them. So just having a standard corporate structure definitely makes it just a more understandable, accessible business. There's likelihood for the dividend. Well, there should be a dividend tax credit on the dividend as well, so that would help. The negatives would be that the AW.UN investors are losing the revenue royalty structure. So, one of the things that we always really liked about AW.UN is that it didn't have exposure to the operational risks of running a restaurant. They were just getting money a cut of the revenue. So, labor costs, um, other costs associated with equipment, with rent, those types of things, real estate. That wasn't really factored directly into what AW.UN was getting for its revenues. But um, losing that royalty structure, now it's just a standard corporation. They have all of those risk exposures. So certainly the level of risk is higher given the exposure to operations. My take is, really, I think that investors could go either way with this. Either taking the cash payout, or if they want to be invested in AW, or the new A&W, then they can continue on with the company. I would just say I'm not necessarily seeing a lot of great value here. It's not, I don't look at Newco and think like, relative to the growth, this is a great value proposition. I'm thinking it's probably more fairly valued. $37 is a nice payout. Certainly it's rewarding the A&W.UN unit holders. We've seen A&W.UN's price much higher in the past, but again, growth was higher in the past. So, that's part of the reason why. And really looking forward, we would be expecting a single digit growth rate. Now, there's always the possibility that A&W expands, perhaps outside of Canada, perhaps into other brands, or does other types of partnerships. But those are really unknowns right now. Based on what I'm seeing, I'm seeing, more or less a fair valuation, but then there are some unknowns as well with the new business. So probably if I wanted to be invested in the new company, you know, I might look for opportunities depending on what, my capital gains tax would be on the $37. I might just take that, look for opportunities to reinvest it. If I'm happy to be in a business, if I like the A&W brand, I would just continue. To own those shares. But yeah, I mean, really, it's probably a reasonable deal for AW.UN unit holders. And certainly it'll be an interesting story to follow going into the future.
Yeah, it is interesting. It looks like they kind of did a similar type analysis to price where the takeout, all cash price is. Again, I would be in agreement that that doesn't, unless they've got future plans to make acquisitions to grow the business beyond. I mean, it's a decent same store sales growth rate, but in the past, like you said, it's been higher, which made it more attractive from
It was in
a
the
growth
double digits
perspective.
for
Yeah,
years,
yeah,
upwards of like 12, 14%, right? Which we always felt was unsustainable. I mean, that was really high.
yeah.
It's what they're projecting is decent. It's not, overly compelling, but it's moderately, reasonably decent.
So to probably trade at 14 and a half times or 14 like QSR does, they're going to have to add another growth element, or, add an acquisition of another or expansion somewhere, I would think. And maybe that's coming. Again, I didn't see anything in the presentation about that, but maybe there is something coming further.